Okay, I think we can start and we can unmute our speakers. Good evening and good morning. Welcome to Caixin Global Webinar. I'm Li Zengxin, the moderator. Thank you for joining the latest of our series of online events. Today, our theme is Oil Goes Under. What's next? As the COVID-19 pandemic continues to rage around the globe, a new watershed moment came on April 20th, when the WTI contract price hit minus $40. This is, of course, an extreme out of the extreme, but is this simply a result of a design flaw, an overshoot, or the beginning of a new era? We have many questions. I think they can be divided into a few layers. First, the oil market itself. What's for the players in it? Producers, downstream sectors, consumers, traders, etc. Layer two, what does that mean for the global economy? And third, geopolitics. On top of all this, what does China fit in? We are glad to have three speakers today with us. They are Mr. Lu Ruquan, Director of International Development, China National Petroleum Corporation. Mr. Roger Diwan, Vice President, Financial Services, IHS Markit. And Mr. Yan Jiantao, Vice President and Chief Strategy Officer, OilChem. Welcome. We have audience calling in on Zoom, and we are also live on Twitter. Welcome to you all. As usual, first I would like to invite each of our speakers to share his thoughts for about 10 minutes. For those watching, you will find a little button on the lower side of your screen called Q&A. You can submit your questions there. We'll answer as many as we can later. And now let's start with Roger Diwan. He's Vice President of IHS Markit. He has more than 25 years of experience in advising governments, oil and gas companies, and financial institutions on oil markets, geopolitics of oil, and assessment of the strategic shifts of the global oil and gas industry. So let's welcome Roger, please. Unmute. Sorry, we have to, yeah, sorry.
Okay.
Okay.
No problem. Good morning and good evening, and thank you for inviting me. I wanted today just to kind of set the scene a little bit where we are in the oil market and talk a little bit about what happened Monday, Tuesday here in the United States. But I want, in a way, to talk really the very special condition of the oil market. And I'm trying to move my presentation, and I'm not having the control. If I could. So if
the arrow, yeah, okay.
Yes, great. So I think the story of the oil market is very simple. What we have here is the biggest demand crash ever, actually bigger than anything we could have ever imagined. The oil market are facing a complete collapse of oil demand, and we believe right now, this week, next week, and the week prior, that maybe we lost globally close to a third of global demand. Nothing like that has happened. Even in the worst time in 2008, 2009, I think the most negative we've been like 3.5% to 4% for one quarter. Here we're talking about a decline in demand about 25% for a quarter. Nothing seen like that. So when you stop consuming so quickly and supply is continuing, it's creating a complete jam in the oil market. We're producing way more than we can transport, store, and consume. So producers have been trying to respond to it, and I think Mr. Lu will expand on what happened in Vienna months ago and what is the deal between Russia and Saudi Arabia. But we managed to put together the producer a very large cut of about 10 million barrels per day. Which is very impressive, again, unprecedented in its size. However, it's just not big enough. And it means that other places in the world will have to shut in production, including in the United States, Canada, Brazil, all the main producers in the world who cannot consume the oil that they're putting out of the ground. So that's the first issue. And we believe that the size of the demand decline mean that supply cannot be very far from demand for more than a quarter, meaning that supply is going to have to adjust to the level of demand destruction. And that creates a risk by itself of filling the storage tank globally very quickly. And once we do that, you can't produce anymore because there's no way to put it. So that supply adjustment is going to be very painful for the industry. And the way it expresses itself is often in prices, in regional prices, in what happened, for example, in Cushing last week. And I'll explain a little bit more what happened, but basically where producer or people who are buying that oil and need to get rid of it have to pay somebody to take it away from them because they don't have storage capacity to put it in. And that's what happened last week. It was on a specific contract with physical delivery at the location where the storage tanks were or full or about to be full. And think about this picture now, not only in Cushing, Oklahoma, which is one area in the United States, but at a global level, meaning that on this chart, what we're trying to say is the difference between supply and demand is such that is bigger than the amount of tankage we have in the world. That cannot be. Oil, if it's produced, it has to be stored and or transported. But it means that right now, the only way you balance these two things is by crushing supply. If we can go to the next slide. Next slide. Yeah. Thank you. And what we're saying here is that demand destruction during the second quarter is such that from the following few quarters, supply is going to have to be under demand, whatever that demand number is. And this is our base case here. We believe there is a good rebound in the third and fourth quarter, and but supply has to be under for us to destock. If the demand number are lower, and if we have a return of the virus and a restart of these shutdowns we're in right now, and you bring down that demand number, you're going to need to bring down the supply number. It's very, very painful for the industry because it's forcing to do things which are not in normal order of business, which is to choke down wells or to shut down wells. And that actually could be complicated, and it's not clear that you get back all the capacity back on when you need it. So you can have a loss of capacity, a loss of productive capacity, and it costs money actually to shut down a field and to bring back a field. And an industry which is really being without money, without cash flow left in the company. If we can go to the next slide. And this is why you see this price structure here. This is the price of oil over the next 60 months. And you see the front end of that curve, so the next 3 months being very low. Now it's even $5 lower, meaning that everybody understands that the crisis in the next 3 to 4 months and prices are extremely low. But over the medium term, market believes that we will get back to $40, $45 Brent and WTI, which is a good news that the balance will be restored. And that's the other element I wanted to talk about when we discussed the surprise agreement between Russia and Saudi Arabia 10 days ago. It was an agreement not only to cut production now, but to cut production for the next 2 years, to basically create a framework to manage oil market for the next phase. As we get out of the virus, we draw down the stocks, we go back to normal. So this oil market is so imbalanced that it will take at least 2 years of heavy management and low prices to restore supply and demand and to draw down the stocks. This is a shock which, because of the physical element of crude trading, you have to take it, store it, and it's very bulky and it's costly to keep. Because of that, it's going to take about 2 years at least to fix it. If we can go to the next slide. And the reason for that, this is a snapshot. We're looking at in terms of gasoline market globally on a weekly basis. So at IHS Markit, we have a lot of data. So all the numbers I'm showing you, we're doing all these balances on a weekly basis, not even on a monthly or quarterly basis. So we're able to adjust because we collect so much data. This is the gasoline demand globally on a weekly basis. And what we see right now is that completely shut in or major shut in exists in 98% of gasoline markets globally. So of the 26 million barrels per day of gasoline demand in the world, 25 million are under complete shut-in or near complete shut-in right now. So this is really, we believe, the bottom of the demand destruction this week, next week, and maybe one more. And after that, we start to see a recovery. If you go back, yeah, you can keep moving the slides. This is the US demand. US demand right now is probably at the level it was last in 1969. So it gives you an idea of the destruction of the demand, and I think it'll be, it looks like it's troughing at these levels. If we can go to the next slide. And that's basically our view of demand over the next 7 quarters, looking at the numbers. The second quarter 2020 is obviously the most damaging one, but the uptake has to be pretty quick in the third and fourth quarter, at least for transportation outside of jet fuel, I would say, pretty quickly to have a balancing. Maybe it's not as good at, on this chart, but that's what's important. But more importantly for oil prices, it's the second quarter 2021 which is going to matter, where we can draw down a lot of the stocks. But to have that certainty that that quarter is going to happen, we will know in the third and the fourth quarter how the virus is coming back or not. So in a way, that recovery in oil price and the destocking depends a lot on our perception of how the economy is going to be able to function during the winter and the possible return, unfortunately, of the virus. If you can go to the next slide. And so that's why this whole notion of how much stocks and capacity to store oil matters. And when you look at it, really, there is 4 areas where we can really store oil: China, United States, Western Europe, and ships. And everywhere else, you have very little storage, meaning that producers who are producing oil but don't have access to a pipeline system or to a storage system or an export outlet and ships coming to take the oil are going to be in trouble. And we're going to see supply shut-ins across the world because there's not enough capacity. If you can go to the next slide. So this is why we believe that in the second quarter, actually, the shut-ins, the global supply shut-in is going to be more in the 17 million barrel per day, not in the 10 million barrel per day that the Vienna Alliance has agreed upon. And we're going to see, I would say, in the United States, in Canada, maybe between 2 and 3 million barrel per day being shut in as we speak. Within the next months and a half, 2 months, we'll have between the two countries close to 3 million barrel per day shut in. And that's going to happen in a number of places, in West Africa, in potentially in Latin America, in Europe, offshore fields. We're going to see these, what I would call Darwinian shut-ins, where basically you don't have any more access to a market or storage, and you have to shut momentarily your field. In Russia also, obviously, they're taking a big chunk of that, 2.5 million barrels per day. The question is how much of that also can come back in a fair amount of time. If we can go one more slide, and I think that would be no, it's fine. Actually, I'll stop here.
Thank you for understanding. Thank you for the solid analysis from the demand and supply side fundamentals that helps us understand why this happened. But we will have more on the Q&A session. Now we turn to Mr. Lu Ruquan. He is Director of International Department of the CNPC. He's also a senior economist specializing in international energy strategies. He had years of experience in Iraq and Sudan and published a series of books, including Belt and Road, Chinese Oil and Gas in the World, and hundreds of published articles and papers. We also appreciate his contribution as a Caixin columnist. Ruquan, please.
Okay, hi, Zhenxing. Hi, everyone. And very nice to be invited as a speaker to talk about the oil market crisis, especially during the last 3 months. But I will focus on the geostrategic and the geopolitical issue. So next slide. I will touch about 5 issues. The first, I will say something about the whole picture. And then I will talk about the 3 players. Let's say the Saudi Arabia, Russia, and the United States. And then the last but not least, I will touch the oil power, the key of the players' cooperation and the competition. Next one. So if we look back the past 3 months, it could be divided into 4 stages. The first stage, we know that beginning from the end of this January, that is the coronavirus happened from China, and so the market becomes more pessimistic. So push the oil price down to below $50 per barrel Brent. And the second stage is, let's say, from the early of March, that is the broke up of the OPEC Plus, and also we call it the Vietnam Alliance. The first, that is Russia left the negotiation table, and then the Saudi Arabia launched the price war, and furtherly pushed the price to $40 and even to $30. And the third stage is the biggest disaster happened, that is the pandemic stage, that is COVID-19 spread from China to the rest of the world, like Iran in Middle East, and also Italian in Europe, and let's say the United States in North America. So furtherly push the oil price down to below $20. And nowadays, that even to the extreme situation happened, that is the future price is a negative one. However, the good news is come to the fourth stage, that is the OPEC Plus recover a little bit, that is return to the market management, that is those big players like Saudi, Russia, United States, and then including also the Mexico, Brazil, and other countries to get together and have a consensus that the production cut will about 10 million barrels per day. But because the over pessimistic of the demand side, so the market still have no reaction on that. Okay, next one. So what about those 3 key players? Let's from the perspective of KSA, Kingdom of Saudi Arabia, I think let's say the political issue is much more important than the economic issues. Let's look at the right side of the slides. We see that actually, if we have looked back longer, that from the World War II, the United States and Saudi Arabia are always allies, and they got the strategy of oil for security. That is, the United States will provide a security for Saudi in the Middle East. However, started from the Obama administration, it's at the beginning of the second 10 year. I mean, it's 2011 that the U.S. troops withdraw from the Iraq, and this year at the February that the U.S. troops withdraw from Afghanistan as well. So for the Saudi, that he's worrying about the security guaranteed by the United States, and so that is have an overreaction on that. And another issue is that he's worrying about Iran, its rivals, and Iran will, let's say, is growing up recent years in Middle East. So at the rivals for more than 1,000 years, the reason why let's say Saudi launched the price war is to beat the Iran's national economy and stop the ability to grow. Let's look at the left side from the perspective of economic issues. For Iran, for Saudi Arabia, so 2 options are okay for them. Both, let's say, either high oil price with small market share, or lower oil price with big market share. I think both are okay for Saudi. So for Saudi, the most important reason is the geopolitical and geostrategical reasons. Then next slides. Then what about for Russia? Russia, in my opinion, is that the economic issue is much more important than the political issue. Of course, Russia is definitely care about the political issues. Let's talk about the left slides. That is the economic issues, I think the key issue why Russia launched the price war is to force or to kick off the shale producers out of the market and to guarantee the market share of himself, of itself, and also for Russia and let's say politically that the price war could help Putin to consolidate his power. We know that he wants to consolidate, continue his present in power, maybe possibly till 2036. Of course, there are some unfavorable reasons to the price war. That is, some big projects, existing project will, let's say, will stop or have to stop because of the economic reasons. Another issue is that is Iran revenge that issued from the, let's say, Russia side to fight against the United States, because the United States issued launched the sanctions on the Nord Stream 2. That is a huge natural gas pipeline project from the Russia to Germany as a revenge to that, and Russia have the price war weapon to kick off the shale gas, oil and gas producer and player. Then next one. What about the United States from the angle of the United States? I think for the Trump administration, the most important issue is also the economic and the re-election of the president. And he must guarantee, or in some degree, he must guarantee the survival of the hundreds of E&P and let's say shale oil producers. However, as according to my observation, that this year 2020 is also okay for those hundreds of players, because about 40% of the production was hedged last year, and so even the price is collapsed now. So the oil players in the United States still have a little bit comfortable about that, but the difficult time will come the next year, 2021, or the year after next, because the debts and the interest will due at the time. So the hard time will come next year and the year after next. Okay, the next, last night, I will have a small conclusion, and I think if we look back, not only the 3 months and a couple of years or decades, that we find that the key is the oil power. Oil power is in the key. No matter US or Saudi Arabia or Russia, they are competing for the oil power. But for oil powers have a lot of meanings. Let's say the national security and energy security, and also the let's say the production and the resources power, and also the financial and oil dollar power, and also the, let's say, some soft power, including, let's say, technical innovation and management regimes are also this. So from this couple of aspects, you can see that the US is still in the car. He has its own oil hegemony. So the United States is still in the center, and he has his problem. He can resolve the problem in his hand. But for Saudi Arabia and for either or for Russia, and so it's not in the core of the big table. So maybe in the next step or in the future years, that the three big players, the so-called 10 million barrels per day producer club players, will continue to cooperation and compete each other, and that's determining the future of the global oil market. That's all for my presentation. Thank you.
Yeah, thank you, Ruquan, for explaining the motives and the strategies behind each of these three big players, why they did what they did. Now we turn to Mr. Jiantao, VP and Chief Strategy Officer, OilChem. Previously, he has worked for IHS Cambridge Energy Research Associates, Goldman Sachs, and BP as a senior and chief analyst. He's author of award-winning books and holds teaching or research positions at schools like University of International Business and Economics and Renmin University. Now it's your turn, Jiantao, please.
Thank you, Mr. Li and Caixin, for the opportunity to speak tonight, and to the rest of the world, our friends. The oil price collapse caught off guards of many of us in China. People are scrambling to cut losses or manage risk exposures. China's crude futures, Shanghai crude, is one of those viable options available. In my session, I'm going to cover two topics. One is briefly global commodity price volatility. Then China's Shanghai crude futures.
So you are controlling the PPT or?
Oh, no, somebody else is. You can scroll the. Okay.
Okay.
Good. Next slide. First, let us look at the price volatility of global commodities by the end of last week in 2020. From the top, you are going to see the gasoline from US, then the WTI, Brent from UK, then the heating oil, the ICE NBP gas price. It tells you that the more difficult to develop, transport, or store a commodity, the hard to use them, the more expensive to transport, store, or use them. This kind of product would be more expensive. The price volatility would be much higher. You can see from the WTI and the Brent, and we can see from the recent event. That's international commodities from gasoline, crude oil, all the way to soybean, gold. The next slide. Here is the price volatility of China's commodities, also from top, starting with INE, Shanghai crude futures, then the oil-related bitumen, fuel oil, PTA. Then if you go all the way down, you can see like a gold steel bar. The same logic applies. The more difficult to transport, store, and use a product, the more expensive to store and use them. We will see the much higher volatility of China's commodity in all those areas. So in order to address the huge price volatility of Chinese, for instance, the crude oil, going to the next slide. On March 26, 2018, China launched Shanghai crude future. It is the first commodity future available to international investors. Next step. Since its launch, China's crude futures outperformed far beyond the market expectations in terms of trading volume, open interest, as well as the number of investors both in and outside of China. Here is one of the examples of open interest. You can see from Shanghai crude, WTI, and Brent, we're seeing that it took about 6 months for WTI and Brent to pass the milestone of 10,000 contracts for open interest. But it only took just 1 month for Shanghai crude to do so and remain that level or above. Next slide. Shanghai crude future is highly correlated with WTI and Brent. You can see from the right hand, Brent versus SC is 97.2%, WTI versus SC is 94.7%, sometimes would be much higher. The Shanghai crude future price closely follow the movements of WTI and Brent for a couple major reasons. Number one, oil market is a global market. Oil price are international prices. China's energy products are priced against international oil prices, including upstream wellhead prices, import energy prices, domestic oil products prices, and even domestic natural gas citygate prices. Next slide. The Shanghai crude has a price premium over WTI and Brent. Since the oil price collapse, Shanghai crude futures trading have been very active. The investors in China and outside of China show very strong interest in Shanghai future. Shanghai futures has the premium over WTI and Brent for a number of reasons, actually a lot of reasons. Let me just tell you a few of them. Number one, the important role of China as importer, consumer, and producer in the oil market. Number two, the Chinese investors in particular have the very familiar with China's domestic market, have much more confidence in China's Shanghai crude. Number three, RMB versus US dollars depreciation. Number four, recent higher VLCC freight rate. Number four, the shorter trading hours and the lack of the night trading windows. Number five, trade price limit. Because the Shanghai crude has a tight price cap and floor, often means that Shanghai crude will take more than 1 day to realize the 1 day price drop or jump in WTI and Brent. It gives more time for the Shanghai crude investors to react. The next point is the time zone difference between the Eastern Hemisphere, represented by Shanghai crude, versus the Western Hemisphere, represented by WTI and Brent. And as I already mentioned, the retail Chinese investors show very strong interest in oil price recovery. Therefore, they flock to the Shanghai crude. The last point is the overall storage along the supply chain. Those are my key points for now. Thank you.
Yeah, thank you, Jiantao, for connecting the Chinese market with the world. And Caixin recently made an exclusive story about the Chinese crude product got very huge loss. So understanding the market is very important. Now let's turn to the second half, Q&As. I may direct a question to one speaker, but others, you are welcome to jump in. The first actually is on shale gas. That should be for Roger. What are the prospects for shale gas companies in the US? And also, will it open the floor of earnings for their hedging positions? You have to unmute yourself. Okay.
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 Can you hear me? No.
Yeah.
So what's happening in the gas market in the United States is very interesting. A large portion of the gas produced in the United States is associated with oil. So basically, the gas production depends on the oil production. And what we're seeing here is a fast decline of the oil production, shutting in volumes, and the associated gas volume are going to go down. What's interesting is that over time, the decline in gas production due to the oil wells create an imbalance in the gas market in the United States. And we believe that by next winter, we'll basically have a tighter gas situation and will increase prices in gas. And we already see it in the future curves of gas prices. Future prices are much higher than they are right now. The question is the price curve pricing too much or too little of that? We believe actually if the US production for oil decline faster in the near term, it is even more bullish for gas. So that gas production in a way will be under the high demand that you have during winter.
Yeah. Mr. Lu, you agree?
Hello?
Yeah, because you touched on a little bit on shale gas earlier. You have objections or agreement with Roger?
Agree.
Yeah. And also you touched on, because this is an election year, and Texas, Ohio, and a few states are very important to President Trump. Do you think if shale companies are in trouble, the government could bail them out? These questions for both of our speakers, Roger and Luke.
Well, if you can hear me, I think there is the administration would like to help the oil industry. It's not clear how you do that very well. I don't think the taxes would not help much, because the industry doesn't pay a lot of tax. It had a lot of deferred tax, and this year will have mostly losses. The question is, could fund be made available? Could the strategic storage be made available to alleviate? I think they're trying to do that. I think on the margins, it won't make a very big difference. The price here is the enforcer of what's going to happen, and the prices are very low. And the prices depend, at the end of the day, of what happened to demand and how supply react. So the bigger the problem we have, the lower the prices, the more the discipline the US companies will have to face. And what the administration can do is really marginal compared to the losses the industry faced. The industry is going to have to go through a very big restructuring. And I don't think you can avoid that when you have such a drop in price, when already it was not very profitable at the $45 and $50. The industry has grown too fast. You have too many marginal players, too many uneconomic wells. All of that is going to have to be restructured, and no amount of aid is available to avoid that.
Richard, anything? Okay. Jiantao, you just touched on the investors. We all know that the BOC contract, but I'm not asking you about the specifics. What should be the strategies for investors, domestically or maybe internationally?
If you look at all the options, I would recommend investors should first look at Shanghai crude futures, because it is most regulated and with relatively lower fees to invest. Second, I would recommend to look into the global equities in oil-related stocks. In particular, if you look at refiners, that would be something worth looking. But I would be very cautious to look at the upstream players today. Thank you.
Yeah, just one follow-up question. I think in another recent comment made by you, you were saying that the downstream sectors, actually there are a lot of M&As going on, and what should we expect for those?
I share my screen to show some slides, because
can leave the control to you?
I have slides right here I want to show.
Okay.
Let's see. Oh, can you see my slide? No?
Yeah. Yeah.
No,
maybe, yeah, maybe you could just speak and.
Okay, now it should be okay, right? Can you say it now? Let me say quickly, if you cannot say it. I'm saying the three trends of transformation as a result of the recent COVID-19 economic recession, as well as the global oil demand downward trends. Number one, if you look at the global oil markets, previously it was driven by supply, but now more and more driven by consumption. Means the consumers, the end users, they have more choice to mandate, to dictate what they need than before. In the past, the consumers, as long as they can buy something at a relative reasonable price, they would be happy. But today they are looking for green energy, safety, reliable, easy to use, easy to pay, and also protection of their privacy. They have so many demands from consumers for the oil producers, suppliers. They have to meet those demands. That's number one. The oil industry is driven from supply side now more and more to the demand side. Number two, if you look at the oil demand areas, currently roughly 60% of global oil demand goes to the transportation sector. China roughly 50%. In the States, roughly 70%. It's all about transportation, but we're going to see more and more oil demand goes to the like chemical, medicine, new plastic materials. Those demand currently only account for roughly 15% to 20%. If we can make a big breakthrough in those new areas, then the oil demand will definitely see another spring, will last longer than people expect. The last transformation trend definitely would be the new energy. I think climate change today is kind of like another victim of COVID-19. People just get busy with their own life and don't really have much time for climate change. But I think I'm saying that new energy or the green energy, they have the strong appetite and they have the strong survival capability to sustain the low oil price. And once the oil price recover further, you are going to see the huge boom in the green energy investments and also the huge fuel competition. Thank you.
Next question is for Ruquan. We have a question asking, will China oil companies stick to the national 7-year action plan and why?
Oh, yeah, let's say as far as I know that we know that China become the largest oil importer and also the gas importer since 2018. So our external oil and gas dependency is uprising. Let's say oil dependency is about 70% last year, and also the natural gas dependency is about 45%. So that's the reason our leader let's say ask those national oil companies to launch to guarantee the national energy security to launch the 7-year action plan. However, under the situation of oil price collapse, those three national oil companies, the first job is to survive, to be alive. So if we do anything, we will do let's say from the perspective of economic value and have an evaluation on that. Another issue is we must guarantee the basic line of the national energy security, that is 200 million tons per year in China mainland. That's the right, we stick to the 7-year action plan. Okay, thank you.
A follow-up question on that is still for you. How much crude storage do you think China has available? What's your expectation for China's oil demand this year? Because we are slowly resuming the work.
You mean the storage volume for industry or even for strategic storage volume?
I think for both.
You know, I'm not very familiar with that the area. As far as I know, that maybe at least 90 days is sufficient. Let's say is a must for the oil storage. But what about the margin left to accept more storage? Maybe Asa know that about that. I'm sorry, I'm not familiar with that.
Okay.
Okay.
Yeah. The other question is how much do you think China's demand will recover this year? I mean, this question could be for you and Roger both.
Oh, for the whole year, let's say, as far as I know that in the first 2 months, especially the February, that the oil demand shrink about let's say 1 million barrels per day, about that. However, I think with the recovery of the national economy in the second quarter, or especially in the third and the fourth quarter, let's say, hopefully that China's the whole oil demand will be equal to last year. Similar, I think, is similar.
Roger?
Well, I don't have the Chinese number in front of me, but I think what China is interesting to watch for us is how it's recovering. It's recovering very strongly. So that give us a hope that on this side, when we're doing these forecasts, that the demand will recover as quickly as we've seen it in China. I think also we're starting to see change in pattern in demand, more use of cars during the week, etc. So we're trying to use a little bit what we're seeing in data in China to model them.
Yeah.
Can I make some supplementary data?
Yeah.
Yes, I got the data, latest data from the ETRI, the think tank from CNPC. That is, according to their prediction, that the whole year, the oil demand for the China, the apparent consuming volume will be 2% increase compared with last year. 2%.
Yeah. Yeah.
Okay.
Next question goes to Roger, because you all touched on OPEC plus, OPEC plus, and we all talk about the deal. OPEC didn't work very well in the past. Why this time it will work better?
Yeah. Well, traditionally, you're right. I mean, when you watch these OPEC deals, the first thing you're trying to see is who's going to comply, who's not going to comply, how much they're going to produce, underproduce, overproduce, etc. So there's a whole parlor game of that. But this time around, you have an enforcement mechanism which is very, very strong. They never really had. It's demand, and demand has disappeared. So for the time being, everybody has to comply and probably over-comply because there's no markets, there's no buyers. So if they have all accepted such a low numbers, they knew that there was no market for their oil. So for me here in the next 2 to 3 months, I think the enforcement will be easy to watch. It's the market who's going to enforce it. Over time, this agreement is very important because it set new baseline for Russia and Saudi Arabia at parity, and they decreased the same amount. And going forward, how much they bring oil at the right time and which volume is going to be very important, because this new phase in the alliance that Mr. Liu has described in a way is based on this parity, the parity between Russia and Saudi Arabia. And as time evolve, how much each of them regain market share and at what price they're willing to add market share becomes very important, because it plays into Mr. Liu's triangle, is depending at what price you bring in production, you would allow or not allow the US production to restart. So that geopolitical game in a way has been right now reduced by the level of demand destruction and demand enforcement as things evolve. I think strategically at what price, what productions come back become very important. And then we will see issues around compliance the same way we see them before, because if you remember that alliance had problems in the last year and a half, they were not agreeing at what price and how to manage the market. This will reappear eventually once the market recover a little bit more.
Yeah, another simple question from our audience. Why is it so difficult to shut down and restart wells? Is this a technical issue or something else? This could be very simple.
Anybody can answer this question. I think there are some technical issues. Some fields are more complicated to shut in depending of if it's an old field, a new field, an offshore field, a small field, a large field, if it's heavy oil or light oil, if it has a lot of pressure or no pressure, if it's oil sand or is it conventional or unconventional. So oil fields come in all different flavors if you want. And we've never seen any experience like that where you have to shut down so much. And some of them actually, when you shut them down, you have really to close them and you need to re-drill them, so it costs capital. Some of them you can just choke them a little bit and add pressure, and when they come back better. Some of them have a lot of water in them, so when you shut them down, they can get flooded. So it's a very large scope here. It's very difficult to tell because we've never seen anything like that.
Next question goes to Jiantao. I think recently you said that we are entering a new normal of low prices, but the last crude oil price was say like 14 to 17. It's only 3 years. What about this time?
Yeah, if you look at the previous history of the oil price recovery, first 1985, then 1997, 2008, 2014. For the shorter period of time of 10 weeks, we'd see the oil price recovery, but mostly it took more than 100 weeks for the complete oil price recovery. What happened since 2014, in 2015, I wrote one article talking about 4 crowding out factors. You need to squeeze out the overcapacity, the excess capital, in particular in the States, the low margin, low capital return projects, and also the inventory. When we look back, all those 4 factors, the oil industry only did well to some extent on the one factor, that is the dropping some low return project. The oil industry did not do well in terms of with the excess capacity, excess production, and also the inventory. So this time around, then we are facing another 4 new drivers of the oil price downward. Number 1 is COVID-19, and number 2 is the economic recession, and number 3 is the global oil demand coming down due to the COVID-19 and other factors, including the green energy. And number 4, of course, inventory. So it will be challenging to come back this time. I think we need more patience to come back more than 10 weeks, maybe 100 weeks or even longer. So we're going to see the oil price to stay lower for longer. That's unfortunately, it's definitely not something I want to see, but that's kind of like the situation now. Thank you.
Yeah, next question to Ruquan and Roger maybe. The question is, China's imports of US crude has fallen significantly since mid-2018 as trade tensions rose. With WTI prices so low, it is an opportunity for China to buy US crude again. Under this price environment, how will China implement the phase 1 trade deal agreement? Will that be possible anymore?
It's a complicated issue. You know, according as you mentioned, that the phase 1, the China-U.S. trade agreement, that totally that we will import the value about more than $50 billion of an oil and gas product from the United States. But since the price is too low, the collapse, so which means that if even we import, let's say 200 million tons, that is still not enough to let's say to meet that volume, the number. You know, 50 billion, it's accounted for 26 of the total, let's say the first stage agreement. That is a huge number. So in my opinion, we should go step by step and wait and see.
Roger, you have something to add?
Well, I think Mr. Ru is right. I mean, just if you're counting it on dollar when the price is divided by 3, you would need to multiply by 3 the volumes, correct? It's a simple equation. But you know, if you're a Chinese refiners right now and you need crude, I think the choices that you have at the prices you want exist. So this is a good time to be a buyer because there's not many buyers out there, a lot of sellers.
Yeah. My next question is to Mr. Yan again. Is in this market turmoil, some fear that China may, withdraw or step back a little bit of its financial sector opening. Do you see that coming?
Yeah, I think we're seeing the big picture of global anti-trade and the global situation against the collaboration among nations. We actually need the cooperation the most today, but we're seeing the opposite actions. That's the big picture. Under this bigger screen, we're seeing the huge efforts by the Chinese government actually to push forward the financial open up policy. For instance, my old employer, Goldman Sachs, is going to be able to have 100% equity share in its China branch. So that's actually a daring step by the Chinese government to do so, including the Chinese Shanghai crude futures and China open up to the international investors. Now, crude oil future is a huge issue globally. So I see definitely some encouraging signs, particularly from China. Thank you.
Yeah. Next one is, as this oil price is so low, what about the green energy or alternative energy sectors? Will there be anybody really interested in them anymore? Any one of you?
Actually, I just mentioned as one of the 3 trends post COVID-19. Today, new energy definitely is suffering and to some extent ignored by people, by the government, but they are adjusting themselves very well, and they are sustaining the very low oil price environment. And I think they will bounce back very quickly once the oil price recover. Thank you.
Okay, I will continue to make some supplementary. That is, in my opinion, the new for the new energy, I think it's a negative stage for the new energy development. The reason is very obviously that no matter people or the enterprises are economical one. So which if a kind of energy, let's say if it is affordable or cheaper or more stable and more reachable, so it will be much more easier to use. So for new energy, even yes, I think the comprehensive cost is still a little bit higher than the traditional oil and gas, especially on the currently the extremely low oil price. Okay.
Yeah, I think what's interesting for the new energy is it changes a little bit the debate going forward in the United States and in Europe. I don't know as much in China and in Asia, but if we're going to have big stimulus programs, and the question becomes is how much new energy will participate into these stimulus programs. And for example, in Europe, there is a real push now that the next stimulus will favor green energy in a way, use this moment as you have to stimulate the economy to do it in a way to reduce the carbon footprint. In the United States, that debate exists also between obviously Republicans and Democrats.
Yeah, a follow-up question. In the longer run perspective, will rising oil demand from Asia, from the East and South Asia, Africa, offset direct declines in the West.
In our forecast, yes, for the next 10 years. After that, it plateaus and comes down. But now the assumptions could be changing, correct? So we need to understand the full effect on demand of what this virus does, and if there is long-term impact on demand, like on jet fuel and on transportation in general. Do pattern changes because of this crisis, or we go back to the world we were before? That's a big debate among forecasters, and I think it's a little bit early to tell.
Yeah. I think we are almost out of time, but I have two small questions for each of you before we end. First is, as our title suggested, we've already seen so much unseen before. We have seen so much historical events now. What will be the next after oil? That's number one. Number two, our audience want to know your projection for the oil price at the end of this year. Maybe we start from Mr. Lu, then Roger, then Yan.
Okay, in my opinion, that is the confidence is the most important issue. Although that the COVID-19 changed the way of people's living style, but if we still keep the confidence, okay, the future will be better. And for the let's say oil price at the end of this year, I think it depends on the, just I mentioned that in my slide, is the cooperation and the competition between those big players. But definitely the best line is the performance of three regions, let's say China and East Asia, and also the North America, and also the West Europe. If let's say in the second quarter and in the future, the economy will be normal and recover. I still have the confidence that it will be recover and come to the balanced the price. Okay, thank you.
Okay, Roger now, please.
Yeah, I agree. I mean, I think the most important factor here to understand what's going to happen to the oil industry is understand how we get out of this situation and what happened in the near term with the virus. Does it come back or not? So taking a moderately optimistic view that in the fall and in the winter, we might have outbreaks, but managed, and we have more of the technology to be able to test and isolate very quickly globally. Oil will recover, and we believe that we could have Brent back close to $40 by the end of the year.
Yep, $40. Mr. Yan?
Yeah, a month ago, I advocated to the market that we have to be careful with negative prices. Of course, this week it happened. Again, in my opinion, the oil price for the Brent should overshoot, maybe all the way to $15 per barrel before the market feel like, okay, we feel comfortable, the price will go up all the way. Otherwise, there's always lingering doubt about whether or not the price will come down again, or can be very volatile. So the price to the end of the year, we're looking at $30+ per barrel. But if you look at the history, the oil price hardly stayed in between $30 and $40 per barrel. So I think it would be a very awkward position in that area. In our opinion, in the longer term, we always look at $50, $55 per barrel for everybody to feel comfortable. Historically, that would be the $20, $25 per barrel. But today we're looking at 55 to be comfortable. I'm not saying that's end of the year, but that's our view all the time. Thank you.
Yeah, like all our speakers said, it ultimately depends on demand, and it ultimately depends on how fast we can get over this pandemic. I hope that could come true sooner than later. Thank you so much, Roger, Jiantao, and Ruquan. This event is organized by Caixin Global Intelligence. We'll put up the key points and the slides online at caixinglobal.com. So stay tuned. Goodbye for now. See you next time. Thank you.
Thank you.
Thank you.
Thank you.
Thank you so much. Bye.
Bye-bye.